So I use the ISM as probably my best guide to the business cycle. And that's kind of at this 48 or so level, 47 point whatever level. And really just below 47 is 100% chance of recession. Now, all the forward-looking indicators like new orders are completely off a cliff. Employment, prices paid, you name it, every single indicator. We have a database of 1,500 indicators at Global Macro Investor, and it's all falling off a cliff. So this is the point where you get to on Twitter where everyone goes, oh my God, there's a recession. Surely stocks are going to go down. No shit, Sherlock. They've already gone down. The Nasdaq went down 37.7%, I think, from the high. But what's interesting is that the forward-looking indicators are starting to suggest that we will hit the bottom of the recessionary wave in about April. So we're likely to get, I think, 2, maybe 3 quarters of negative GDP. But I think it's more akin to the 1990 style recession, which was the stock market fell 20%, the economy fell 2%, ISM went down to 40 or so. It all recovered. There was some overhang. The economy was slow for a while and then eventually recovered. A normal garden recession. That's what I think we're in the middle of.
On February 1st and February 2nd, Bitcoin's price surpassed even the most bullish price projections after the U.S. Federal Reserve announced plans to raise interest rates by 25 basis points. Even though Fed Chair Jerome Powell told investors not to wait for interest rate cuts in 2023, during his press conference, he did clearly state that the employment data is currently the main focus. Hello and welcome to Money Talks. In today's video, Real Vision CEO Raoul updates about his outlook for Bitcoin in 2023. Raoul also breaks down the importance of regulatory clarity in the space and how it will drive the future of institutional adoption in crypto.
I think people are confusing prices, which is the unwind of the prices as in markets, the unwind of everything that happened in 2021 got unwound in 2022. And I saw Dario Perkins on Twitter calling it the A-shaped economy. So as opposed to a V-shape, it was an A-shape. So it went up, came back down, and it's reverted back to trend. So almost all of the charts have reverted back to trend. I think oil still got a bit of a way to go. Nat gas got there. Most of the commodities have got there. Most of these things are down 30, 40, 50, 60, 70% now, taking the inflation fears out. But this recessionary thing is what's in everybody's head. And the narrative in the market is, well, just wait for the earnings leg. Do you not remember 2001? Do you not remember the second leg in 2008? Those were very different styles of recession to that, in my view. Of course, I could be wrong. My guess is when I look at the rate of change of the S&P or the Nasdaq, they've all entirely priced in a recession. So the Nasdaq priced in an ISM of about 37, which is where my forward-looking indicator, my Global Macro Investor Financial Conditions Index, has been pricing the bottom of the ISM trough. And it's all coming around the same date. So what's happened is the markets have been forward-looking. They discounted the recession fast, and they're now starting to discount the pickup on the other side. And that's coinciding with the rate of change of Fed increases coming down. The ECB are the same, the Bank of England are the same. Everybody's slowing down their rate increases and are going to pause mode. Whether we get one more hike or not, I doubt it actually, but there's a chance we get one more pause. The bond market's starting to realize that that's probably the case as well. Also, global liquidity, M2 cycle, stuff like that, that's been picking up. It started with China, and it's going to start resonating throughout the world. Things like the falling dollar, falling commodity prices start picking up this kind of rate of change of liquidity. That also suggests that we kind of are bottoming around these levels. So we've got global liquidity bottoming. We've got the rate of change of interest rates that's taken the pressure off the neck. You know, Jay Powell's had his foot on the neck of the markets and the economy. So he takes his foot off. Things can rise again. So that's kind of what stage we're seeing now. I think earnings have been discounted in prices. I know the bottoms up guys say, well, this is not right. And almost everybody on Twitter says that. I keep asking the poll. Everybody's still very bearish. All of the sentiment indicates everyone's maximum bearish. And I, using my macro framework I've been using for 18 years, I just don't think that's the case. Now, we're talking probabilities, not certainties. So anything can change here. But my view is that overall is that the worst is behind us. It bottomed in October when I wrote a big Twitter article and a big global macro investor piece calling it the bear market killer, which is October. And bang on schedule, the whole bear market stopped in October. I had lots of technical signals like DMARC counts telling me the monthly and weekly and daily that this was probably the low. I'd already had that in crypto back in June for ETH, and then again in Bitcoin and others into October. So we've got this perfect set of signals across everything. The liquidity cycle picking up, maximum bearish sentiment, the worst I've ever seen. And I think in Global Macro Investor, we put together 40 of these sentiment indicators of stuff going back to the 60s. And it was the worst sentiment the markets have ever seen. And then we had the option buying and all of that, the put option buying, all of that stuff. So I'm now bullish risk. And I've been flagging this for a while. And I flagged it when I started buying crypto in June. And I flagged it when I re-added it. And I've been talking about, I think the inflationary pressure's coming. I think inflation goes negative next year. Actually, this year, sorry. I think the rate of decline of commodities is much sharper than anybody realizes. I think wages are rolling over. I also think rents are rolling over. So the whole lot is coming down. And that will go all the way through till 2024.
After testing the $22,500 support on February 1st, Bitcoin gained 6.5% in 5 hours and has since been flirting with the $24,000 level. While the recent gains are exciting, traders should note that the improvement in crypto market sentiment tracked the risk-on attitude seen in traditional markets. Stocks with negative operating margin presented significant gains on February 2nd, including Coinbase 20%, Cloudflare 15%, Unity Software 12%, and DoorDash 10%. That factor alone should be a warning sign that the gains of the last few weeks might not be sustainable. It's also important to remember that Bitcoin's 40-day correlation to the S&P 500 remains above 75%. Potential regulatory headwinds could also have played a vital role in supporting Bitcoin's upside. Huang Yiping, a former member of the Monetary Policy Committee at People's Bank of China, recently argued that a permanent ban on crypto could result in many missed opportunities.
So we've got rid of the inflation. We've got a weaker dollar, global growth picking up, forward-looking indicators picking up. Technology should outperform. This is very much like the 2018 episode where the Fed stopped hiking. That was December 2018. The markets just went on a tear. The Fed eventually cut rates in August 2019 and then stopped QT in September 2019. Over that period, I think Bitcoin did 285%, and many of the markets did really well over the course of that year. And generally speaking, at this point in the cycle, the kind of macro spring, you just tend to see the S&P doing this, the NASDAQ doing this, growth tech doing that, and crypto doing that. And that's my expectation that if you're, not volatility adjusting the returns, you want to get the fastest horse, it's likely to be crypto, then it'll be technology stocks, the growthy end, stuff like ARK is already up 100% or so. Then it'll be the NASDAQ, and then it'll be the S&P. Commodities tend to do okay. Cyclical companies tend to do pretty well in this environment as well, tend not to outperform technology. Emerging markets tend to do pretty well, particularly if the dollar's slightly weak. So that's kind of where we are. We then start focusing going forwards on, okay, what else does this mean? And this is what you're starting to see in things like gold. They're picking up the potential for easing, negative real rates, that kind of stuff. And that's the next phase that I think we come into in the latter parts of 2023. And I think we'll see significant easing for a whole host of reasons in 2023, back end 2024, and back to quantitative easing that I think we'll get by in 2024, maybe even 2023. We'll wait and see. So that's basically the macro setup for me. I'm very bullish risk, bullish crypto, bullish technology, bullish carbon credits, bullish bonds, bullish gold. Don't really have any of it. Starting to wait for things like copper because we got some secular backdrops. I like secular trends. I don't tend to trade the cyclical stuff anymore. I find it a bit boring, and I don't think it's very easy to make money consistently over time. I like a secular trend, and when, for example, when you look at the technology stocks, like we can take the NASDAQ. If we take the NASDAQ on a log chart, we've come back to the bottom of the log trend channel. And we've had all of the bottom indicators and signals. And usually if you can buy the cyclical sell-off when it hits the secular trend, that is the sweet spot. We're in that sweet spot now. We're in the sweet spot in crypto, technology. We will get there probably in copper as well, and a few other markets where it starts to get very, very interesting for very high future expected returns. We saw something not dissimilar in carbon as well. So that's where we are. Cyclical pressures down to the secular trend. I love my secular trends. My big secular trends are India, technology, exponential age technology. That's a whole host of things, from robotics to AI to EV to distributed data to metaverse. All sorts of things come in that bucket, and I've been writing quite a lot about that over the last few years. Exponential age is the other big theme. Stuff like, I like the Middle East, and maybe Saudi Arabia is the one harder to trade, but I think it's really interesting. I'm bullish on copper, as I said, carbon, for those reasons as well. And then crypto is the bigger bet for me because I think it has a higher expected return, comes with more volatility, but I'm happy to stomach the volatility because I've got an income, thank God. And so that means I can allow the volatility of my portfolio moving around because I've got money coming in. But if you're trying to live off crypto, it's bloody difficult because it goes up and down a lot.
So, is it a good time to invest in Bitcoin? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.